$4,000 gold is here. What this means for your money. What if the very foundation of our global financial system is undergoing a seismic shift right now, and the tremors are being felt not in the stock market, but in the price of an ancient yellow metal? We are witnessing a historic moment as gold charges towards the $4,000 an ounce threshold, a level once relegated to the fantasies of the most ardent bulls. This isn't just another rally. It's a fundamental repricing that questions the very nature of money and safety in the 21st century. We are on the precipice of a new era, and the implications for investors, for nations, and for the future of wealth itself are staggering. This surge is a symptom of a much deeper condition affecting the global economy, a story we will unpack today. The prevailing economic landscape is riddled with paradoxes and fraught with peril, creating a fertile ground for this unprecedented flight to tangible assets. While equity markets have painted a picture of bullish optimism, setting records with an air of invincibility, a powerful undercurrent of unease is pulling investors towards the traditional safe harbor of gold. This anxiety is not unfounded. It stems from a confluence of destabilizing factors: persistent political upheaval, highlighted by a disruptive U.S. government shutdown that has injected chaos and uncertainty into the markets, and a growing apprehension about the long-term stability of the entire financial architecture. This isn't just market jitters, it's a rational response to a system showing visible signs of strain. At the heart of the problem is the diminishing allure of assets once considered the bedrock of any conservative portfolio: the U.S. dollar and federal government bonds. For decades, these instruments have been the undisputed safe havens in times of turmoil. Yet their status is now being actively questioned, and in many circles rejected. The dollar, despite momentary upticks, has been caught in a depreciating trend, weakened by the prospect of continued monetary easing. Simultaneously, America's creditworthiness is under a cloud, shadowed by ballooning national debt and deficits, a concern punctuated by a recent credit rating downgrade that has sent ripples of doubt through the global investment community. The catalyst for this monumental shift is not a single event, but a powerful convergence of forces that have been building for years, now reaching a crescendo. The most significant of these is the aggressive and sustained purchasing of gold by central banks across the world. This is not a tactical adjustment, but a strategic pivot of historic proportions, representing a deliberate move away from dollar-denominated assets. Nations, particularly emerging market powers, are actively seeking to insulate their reserves from U.S. fiscal policy and geopolitical leverage, a trend often referred to as de-dollarization. This official sector buying provides a formidable and consistent source of demand, creating a solid floor under the gold price. The scale of this central bank activity is truly staggering and cannot be overstated. Since 2022, sovereign institutions have been accumulating physical gold at a pace not seen in over half a century, effectively since the end of the Bretton Woods system. In the last few years alone, they have absorbed thousands of metric tons, with nations like China and Russia leading the charge as they strategically bolster their reserves. This sustained buying spree now accounts for a significant portion of total annual gold demand, fundamentally altering market dynamics and creating a tightness that amplifies the effect of any new investment inflows. Parallel to this sovereign-led movement is a powerful surge in private investor demand, adding immense momentum to the rally. Money managers, institutional funds, and even large individual investors are piling into gold, seeking refuge from the growing storm. This is evidenced by the massive inflows into gold-backed exchange-traded funds, or ETFs, which have purchased hundreds of metric tons of the precious metal. The recent flow of capital into the largest gold-backed funds has been surpassed only once in the past 2 decades, signaling a profound loss of confidence in traditional financial assets and a desperate search for a reliable store of value. The second critical catalyst is the clear and dovish trajectory of the Federal Reserve. Markets are now pricing in an extremely high probability of continued interest rate cuts throughout the remainder of the year and into the next. This monetary policy stance is unequivocally bullish for gold. Lower interest rates dramatically reduce the opportunity cost of holding a non-yielding asset like gold, making it far more attractive compared to government bonds or cash deposits that offer diminishing returns. The prospect of a sustained period of accommodative monetary policy is acting like rocket fuel for precious metals prices. This anticipated monetary easing is not occurring in a vacuum. It is a direct response to signs of weakness in the labor market and the persistent risk of a recession, or worse, a period of stagflation where economic growth stagnates while inflation remains stubbornly high. This puts the Federal Reserve in a difficult position, essentially compelling them to lower rates to stimulate the economy, even if it risks further devaluing the dollar. This dynamic creates a self-reinforcing loop that benefits gold. Economic weakness prompts rate cuts, which in turn weakens the dollar and enhances gold's appeal as a monetary alternative. Compounding these factors is a fragile and increasingly unstable geopolitical landscape. The world is a tinderbox of conflicts and political crises, each one adding to the risk-off sentiment that drives investors toward safety. In the United States, a protracted government shutdown is creating an information vacuum, as crucial economic data releases are delayed, leaving market watchers and policymakers alike flying blind and fueling deep consternation about the health of the economy. This paralysis in Washington undermines confidence in the country's ability to manage its fiscal affairs, further tarnishing the reputation of U.S. assets. The geopolitical instability extends far beyond American shores, creating a global tapestry of uncertainty. In Asia, the surprise election of a new political leader in Japan who favors aggressive spending and lower interest rates has sent shockwaves through the currency markets, hitting the Japanese yen, another traditional safe haven. Meanwhile, in Europe, the political scene is in disarray, with the abrupt resignation of France's prime minister shortly after forming a cabinet destabilizing the outlook and dragging down the euro. These cascading crises leave investors with dwindling options, increasingly pointing them towards the perceived universal safety of gold. We have now reached a critical tipping point where these disparate threads of economic weakness, monetary policy shifts, and geopolitical turmoil have woven together to create an irreversible momentum for precious metals. The recent credit rating downgrade of the United States by Moody's was a significant psychological blow, stripping away the last vestiges of the nation's top-tier credit rating from all major agencies. This formal recognition of America's deteriorating fiscal health has validated the concerns of investors who have been shifting away from U.S. assets, lending further credence to the gold rally. This moment is defined by the failure of traditional correlations. On many days, we are seeing gold, silver, and even the U.S. dollar rise simultaneously, a rare occurrence that signals profound market dislocation and fear. Typically, a rising dollar acts as a headwind for gold, as it makes the metal more expensive for foreign buyers. The breakdown of this inverse relationship suggests that the flight to safety is so intense that investors are grabbing any and all assets perceived as havens, with gold being the ultimate destination. This is a clear signal that the underlying drivers are structural, not merely cyclical. The market's expectation of future Federal Reserve action has solidified into near certainty, becoming a critical component of this tipping point. Financial instruments like the FedWatch tool show that the probability of another quarter-point rate cut at the upcoming October meeting is overwhelmingly high, exceeding 90%. Furthermore, the market is already pricing in an additional rate cut in December. This collective belief that the central bank is locked into a path of monetary easing has removed any ambiguity, giving a clear green light for investors to continue allocating capital to non-yielding assets like gold and silver. The result of this perfect storm is the dramatic price action we are witnessing today. Gold has not just risen, it has exploded, surging by approximately 50% this year alone and consistently setting a series of new records. It has now pushed to within a stone's throw of $4,000, touching levels as high as $3,970 in recent trading. Crucially, this is not just a nominal high. When adjusted for inflation, gold is charting new territory, making 2025 its best year in history in real terms. This is a powerful statement about the erosion of purchasing power in fiat currencies. Silver, gold's more volatile counterpart, is also experiencing a spectacular rally, benefiting immensely from the tailwinds driving the entire precious metals complex. The white metal has surged to nearly $49 an ounce, reaching $48.60 and getting tantalizingly close to its nominal record high. While gold has been the headline act, silver's performance has been dramatic, breaking records in numerous other currencies around the world even before it does so against the US dollar. This broad-based strength underscores the global nature of this flight to hard assets. A unique and powerful dynamic is adding fuel to silver's fire, a squeeze on short positions in the market. Unlike a typical rally driven purely by buying demand, this surge is being amplified by traders who had bet on silver's price falling. As the price climbs, these short sellers are forced to buy silver to cover their losing positions, which in turn creates more buying pressure and pushes the price even higher. This technical phenomenon, a classic short squeeze, is adding a layer of explosive potential to silver's ascent, making its underperformance relative to gold on any given day a surprising anomaly. Beyond the headline metals, the bull market is rippling through the entire precious metals sector. Palladium, a critical component in automotive catalytic converters, has seen its price explode by over 5% in a single day. Platinum, with its own diverse industrial and investment demand, is also posting solid gains. This widespread strength indicates that the rally is not isolated to monetary concerns alone, but reflects a broader revaluation of all tangible and scarce assets in an environment of financial uncertainty and a debasement of paper currencies. The impact of this metals rally is creating a secondary boom in the shares of the companies that mine them. An index tracking the performance of gold mining companies on the New York Stock Exchange has more than doubled this year, reflecting the incredible operating leverage these firms have to the rising price of their underlying commodity. While there have been some hiccups, particularly among silver miners who have occasionally lagged the metal's price, the overall trend for the sector has been overwhelmingly positive, rewarding investors who sought leveraged exposure to the bull market. The aftermath of this surge is a fundamentally altered financial landscape. The very definition of a safe haven is being rewritten before our eyes. For decades, the answer was simple: US Treasuries and the dollar. Today, that answer is no longer clear. A growing consensus among sovereign nations and institutional investors alike is that true safety lies in a tangible asset that carries no counterparty risk and cannot be devalued by a printing press. Gold is re-emerging as a strategic reserve asset of the highest order, a diversifier against the very system it underpins. This shift represents a significant acceleration of the de-dollarization trend that has been simmering for years. The aggressive accumulation of gold by central banks is a clear vote of no confidence in the long-term stability of the US dollar as the world's sole reserve currency. These institutions are not just hedging, they are actively building an alternative system, one in which gold plays a much more central role. The movement from private investors is now adding a powerful tailwind to this official sector pivot, creating a feedback loop that could propel prices even higher in the months and years to come. For individual investors, the landscape has also changed dramatically. The traditional 60-40 portfolio of stocks and bonds is proving inadequate in this new environment. The rally in precious metals has served as a stark reminder of the importance of true diversification. It has highlighted the risks of being overly exposed to paper assets at a time of immense geopolitical and economic uncertainty. The conversation is shifting from whether to own precious metals to how much to own as a core strategic allocation for long-term wealth preservation. Looking ahead, the forces underpinning this bull market show no signs of abating. The Federal Reserve appears locked into its rate-cutting cycle, providing a persistent tailwind. Geopolitical tensions remain high, and the structural issues of massive global debt and deficits are unresolved. Analysts at major investment banks are now forecasting even higher prices, with some projecting gold will reach $4,300 per ounce by the end of next year. While corrections are inevitable, the fundamental and structural supports for this rally remain firmly in place. The situation with silver remains particularly compelling. While it has rallied significantly, it still has a long way to go to reach its inflation-adjusted all-time high. The historical peak from 1980, when adjusted for decades of currency debasement, would be equivalent to well over $100 an ounce today. This suggests that even as it approaches its nominal record of around $50, silver may still be significantly undervalued in real terms, offering substantial upside potential, especially if the short squeeze continues to intensify and industrial demand remains robust. It is also critical to analyze the market's physical dynamics. Unlike previous bull markets that were driven largely by speculation in the paper futures market, this rally appears to be firmly rooted in physical demand. Indicators that measure the relationship between futures and spot prices show remarkable stability, suggesting that strong buying of physical bars and coins is absorbing available supply. This robust physical underpinning makes the rally more sustainable and less susceptible to the kind of sharp, speculative sell-offs that have ended previous bull runs. The performance of mining equities, despite their strong gains, also suggests the bull market may have further to run. Historically, in mature precious metals bull markets, the mining stocks significantly outperform the metals themselves due to their expanding profit margins. While the miners have performed well, their outperformance has at times been inconsistent. If we enter a phase where the mining stocks begin to consistently and dramatically lead the metals higher, it would signal a new wave of investor confidence and could precede another major leg up in the price of gold and silver themselves. The broader economic disruption caused by technological change, such as the AI revolution and its potential impact on employment, may introduce another layer of uncertainty that supports precious metals in the long run. Any significant increase in structural unemployment or economic instability resulting from these technological shifts would likely lead to more accommodative monetary policies and a greater need for safe haven assets, reinforcing the core arguments for holding gold as a long-term strategic asset. Investors must, however, remain disciplined. Even in the most powerful bull markets, sharp corrections can and do occur. The temptation to chase prices after a parabolic move can be strong, but it is often wiser to wait for pullbacks to accumulate a position. The psychology of investing dictates that one should almost expect a price drop immediately after making a purchase. This mental preparation is key to navigating the volatility inherent in these markets and maintaining a long-term perspective without being shaken out by short-term price swings. It's also important to consider the potential risks that could derail this rally, however unlikely they may seem at present. An unexpected and hawkish pivot by the Federal Reserve to combat a sudden resurgence in inflation would be a major headwind. A significant and sustained strengthening of the US dollar could also temporarily halt the advance. Finally, a severe financial crisis could lead to a liquidity-driven sell-off across all asset classes, including gold, as investors are forced to sell what they can, not what they want to. The ultimate takeaway from this extraordinary market action is that we are in the midst of a profound and structural reevaluation of gold's role in the global financial system. This is not a fleeting, speculative mania, but a response to deep-seated concerns about the future of fiat currencies, the stability of the political order, and the soundness of the entire debt-based monetary system. Central banks, institutions, and individuals are all coming to the same conclusion. In a world of unprecedented uncertainty, tangible, non-sovereign assets are an essential component of any resilient portfolio. The lesson for every investor is the enduring principle of diversification and the critical importance of owning assets that lie outside the traditional financial system. The surge in gold and silver is a clear warning signal about the fragility of the status quo. It demonstrates that true wealth preservation is not just about seeking returns, but about hedging against systemic risk. The near $4,000 gold price is not the end of the story. It is a headline in the first chapter of a new monetary era that is just beginning to unfold.